So with that, let's go to chapter 3 because that's where you're really here for. Let's see. Let me go chapter.
Okay, so Brian, I have a really quick question for you.
Yeah.
I know you did this for me last semester, and yes, this is my more than one time taking this class for anybody interested. Last time you sent me a download of the results from my exam one.
Yes.
Can I get that for this time?
Happy to do that. Yeah. Just send me a note, just a little quick email that says I need
Got it.
my exam results.
Okay.
Some people have done that. I have copied it and sent it over, but I don't do it as a matter of course because, like I said, there's 40 people per class, and in reality, there's about half of them are getting A's and B's and really don't care, and then there's others that do care, and I just don't know who. And so I'm very much a ask and you shall receive kind of a guy, as long as it doesn't go against the syllabus or go against your free agency to figure it out, one thing or another. But I definitely will send that.
Oh, and I just found your ethics primer video. So I'm still trying to figure out how to get just your videos. And if I do just Accounting 201 Brian Lewis, I get all of yours on top.
Oh, there you go. Yeah, you might be able to subscribe to, and you'll put the little channel thing on you. I mean, I like the YouTube thing because it's a nice way of consolidating all these videos that I do. If I throw them into the just into the BYU system, they get lost. And if I throw them into the other places, they get lost. You can't really get to them. So there's a nice, easy way to go and get those videos anytime. And if I've mentioned it before, this goes all the way for last semester, all the way through week 14, right? So if you're a little bit ahead and you want to see what's going on, you can always go to those videos up front and get a primer on what's coming forward before I do another one. Okay, so chapter 3, we good? Want to start on that here? Okay, if you remember, this is all about making adjusting entries for revenues or expenses. And it's either to bring revenue and expenses forward, meaning in the current time, or to push them back into the future somehow, right? So either deferring or accruing is what it's really called. Deferral is pushing it forward. Accruing is bringing it forward. Pushing it forward, bringing it forward. I'm not sure that it makes sense, but it will in just a second. Okay. Because what you're really trying to do is you're trying to match your revenues with your expenses. So if I earn some money and there's an expense associated with it, I want the numbers to be on the balance sheet or the income statement at the same time, right? I don't want to receive cash and record it as revenue, but then have the expenses later on and have a mix of revenue versus expenses. Okay. Yeah.
All right. So question, you talked about revenues. And I think for clarity, this is where we're talking more about the unearned revenue, because unearned revenue is stuff that you have already done work for, but you haven't been reimbursed for, correct?
It's both though. Yes.
Okay,
Unearned
so
revenue is something that you have received cash for effectively,
like a
but you
subscription.
perform the work, like subscriptions. Yes. Like
Okay.
an annual subscription, right? 12 months worth of a subscription, you pay for it up front, but the company doesn't recognize the revenue until they actually start delivering subscriptions to you.
Okay.
Okay. The magazine or whatever it happens to be, software subscriptions, right? They don't get the revenue associated with it. They don't get to record the revenue associated with it until they actually perform the service or met their
Okay.
obligations.
So when they get the money up front, your cash account is going to be increased because you just literally took money in.
Yeah,
That's never going to change. It's
that's
the
right.
other side of the revenue. Your revenue is going to be unearned in the beginning, and then as the bills go out each month, you do your adjustments to your unearned revenue to then your actual revenue,
That's right.
subscription revenue or whatever.
Yep. Yep. And so, in just the most simplest, version of this, right? If I do my assets, equals, goodness gracious, equals liabilities, right? That didn't look right, very good. Liabilities plus equity, right? When I receive, let's say, a subscription. Oh, forgive the the craziness. Let's say I receive $1,000 in cash, right? It goes in as an asset. Well, it has to go someplace else, either on the liabilities and equity, or as an offset to the asset. But so what it really does initially is go to your liability because you haven't performed any service yet. Okay. And then when you actually, let's say, let me sell subscription. Okay. So this $1,000 is the cash. Oops, man, slow down, Brian. Okay. Cash, and the liability would be to unearned revenue. Okay, I'm just simplifying this a little bit. Then when you actually perform, let's say perform, I don't know what you would, let's see, let's just say send the magazine. That's probably the easiest. Okay, so it's a magazine subscription back in the day. And let's say it's over 12 months, so let's make this easier. It's $1,200. Okay, and every month you get to earn $100 for that subscription that you send out. So you're not going to do anything on cash, but what you're going to do is you're going to reduce your liability, unearned revenue. Okay, and then you're going to increase your equity effectively through recording it to revenue. Okay, so you're just moving the money back and forth. This is probably the simplest way of viewing it. Of course, the journal entries look a little differently, but from just an assets equals liabilities plus equity, this is how the transactions end up happening. All right. So in the end, your net is you still have $1,200 in cash, but your liability is now $1,100, and you have revenue of $100, or as it flows into retained earnings as $100, right? So that's how that ends up showing up. Now, on the opposite side, you might think of, okay, so this is selling a subscription. And so in this case, I'm deferring revenue, right? Because instead of recognizing the revenue in the period that I received the cash, I put it in as a liability, recognizing that I have some service to perform in the future, and therefore I'm deferring revenue. This is the kind of the deferring view. Okay. And I probably spelled that wrong. Anyway, okay. But in the accruing revenue, the question is, well, how does that accrue revenue? When would you do accruing revenue? Anybody know based on your reading so far? When would you accrue revenue? It's just the opposite of this, right? You haven't received the cash yet, but you have performed the service.
Yeah, so when you perform the service, you would record it.
Exactly. Yeah, so that this is usually is like on it's a variety of ways, but the simplest way is, let's say you're selling hours, you're consulting for somebody. You've done the work for them, but you haven't gotten the cash yet. So I'm gonna perform a service. Okay. And let's say it's $100 an hour. Okay. And I spent 1 hour for, well, make it, yeah, 1 hour doing some work for a client. So I'm end up having an asset, but that's going to go to what might be called accounts receivable. Okay, initially, because I'm earning, I haven't received the cash yet. It's a receivable that will be paid in the future, but I haven't really received it in cash yet. And then what'll happen is that I have to recognize the revenue. So I can put that $100 right now into revenue. Okay, I haven't received the cash yet, but I've performed the service. So you see the both sides of the equation, asset equals liability, which is 0 plus equity of 100. Now, when I actually receive the cash, client pays, okay, then I'm going to get that $100 in cash. Okay, but I'm gonna minus $100 from revenue. Oops. Okay, so the net effect is all on the asset side. It's just a zero. And revenue stays at $100. And now instead of AR showing, excuse me, I said that wrong.
That's, yeah.
AR, right? So instead of AR showing, AR now has a balance of 0, cash has a balance of 100, and revenue has a balance of 100. So I'm still equal on both sides. Okay. Now the journal entries here, just to be clear about this, okay, let's make this a little bit. The journal entry is on something like this, right? You have your accounts, you have your debits, and you have your credits. Okay, so on this one right here,
Okay, so
your account's going to be accounts receivable for 100, and you're going to have revenue for 100. Okay, on whatever date it's performed. Let's say it's 1/1/2023. Okay, and then when the client pays, then let's say it's on 1/30/2023. When they pay, then you're going to get the cash of 100, and you're going to credit your accounts receivable for 100. Okay, this is how the journal entries look effectively. Up here, let's copy this over. Up here on the top on the deferral, just so you can see the full deal on this one, then you're going to, let's move this down. Okay, so on this one, you're going to get your debit first. So your debit is going to be cash. Oops, let's do this same thing. 1/1/2023. You're going to get cash of 1,200, and that's going to go to unearned revenue for 1,200. Okay, and then over here, let's say when you send your first magazine order, let's say it's 1/31/2023, you're going to debit unearned revenue. Oops, sorry. Unearned revenue. Okay, that's going to be 100, and you're going to credit revenue for 100. Okay, so slightly different ways of looking at it, but this is insert. This is the accounting equation kind of view of it. This is the actual journal entry view of that same set of transactions. Okay, so when we look at let's see if we can go here, look at let's see if they got here in the revenue cash basis. So this tells you the difference between cash basis and accrual, why you're doing this. I've explained that a little bit. Let's go to revenues first. Okay, revenue. Okay, so in these unearned revenues, do they have examples in here? Okay, unearned consulting revenue. Usually this is like a retainer, right? So they gave you a retainer, $3,000, you haven't earned it, so you earn it over time. It could also be associated with, so they just talked about unearned, rent, same thing. Okay, so anything you can think of where you receive cash up front, but you haven't performed the service. So it could, it could be rent, it could be services, it could be subscriptions, software licenses, things like that, where they're obligated, the company's obligated to perform some level of service over a period of time.
Necessary in this. And so
in construction, that might be like a mobilization payment, where maybe the company gets a certain amount of money to actually get out on site. And so they're going to receive a mobilization payment, let's say of $100,000. Well, they get that up front, but then as they start to mobilize equipment and people and materials on site, then they'll start to recognize the revenue associated with it. There's lots of different ways that this can happen, but it's primarily because you've gotten the cash up front, but haven't done anything for it yet. Any questions there? Okay, so if we take the same thing and we copy it, we make it, move our copy, and we make it expenses, then we can basically just take everything out here, and you can just say, okay, defer expenses. And you can accrue expenses. Now, all the accounts are going to be a little bit different, right? But all the same logic applies, right? So I'm just going to take all these things out. And we'll leave the numbers in. We'll just use them as placeholders. Okay, so I've taken all that stuff out, right? So the question is, when would you defer an expense? Oh, when would you defer an expense? Ah, okay, got it. Put my thinking cap on. When would you pay for something for, let's say, a year, but not have actually incurred the expense yet, or actually used the expense? In your
When you do
personal
something
lives,
on credit,
something on credit, yep, that would be a form of that. Something more, something outside of that would also include things like insurance,
prepaid,
prepaid expenses. That's right. Anything that ends up being prepaid up front, but then you actually, use it over time, is going to be a deferred expense. So let's say it's called prepaid insurance, paid annual insurance. Okay, same number over 12 months, $100 a month. So the asset is going to be prepaid expenses, but it could be, let's say, in prepaid insurance. Okay, that's your asset, but that doesn't work here because you actually paid the cash for it. So what ends up happening is, we're just move this down. It's going to look like the other one. So you're going to have $1,200 in prepaid insurance. I should have left that up there, sorry. And then the negative $1,200 is from cash. Okay, take these out for now. And take this out. Okay, so that's your first entry. And so what it ends up doing is prepaid. Insurance for $1,200 and cash is credited. That's your first entry. Okay. Your next entry is, since you paid, it's an annual insurance, 12 months. So you're going to take $1,200 divided by 12 and you get $100 a month, right? So when you actually use or consume that insurance, if you will, a month in, then you're going to recognize, let's call it, I'm going to call it, lack of a better word, it's called, used your insurance. Okay. Or effectively 1 month that it has expired. And so in this case, now you're going to take out $100 from prepaid. And you're going to expense it, which ends up being a negative as well. Okay. And the way that looks is you have an insurance expense and you have prepaid. Okay. Does that first one follow? So this is the first transaction, you paid for it, but you haven't really used any of your insurance. This next transaction is, you've gotten to the end of the month, you've used that insurance, and therefore you can expense $100 of it and leave $100, effectively take $100 out of prepaid insurance, which means you have $1,100 left in prepaid insurance. Okay. Any questions so far? Mary, you came off mute.
Oh, I was just gonna say that it makes sense. Makes more
Okay.
sense the way you
Alright.
figured it out than me reading it from the book. So
Yeah. Okay, so then accrual is just the opposite effectively, and we'll walk through an example of that. And so in this case, back to this example, right? You actually have a dual entry because not only did you perform the service, but you actually incurred the cost, your labor hour. And let's say it's a 3-ish multiplier. You pay your employee $30 and you bill that individual at $100. Okay. So let's say that's $30. So what we're going to do when the employee actually worked an hour, this would be prepaid. Let's see. I'm not sure that's not going to, let's start this over. This is going to be a little different. Okay. So the employee worked an hour for $30. And so you have to accrue that expense because you haven't paid them yet, right? They get paid like every 2 weeks or every month, some frequency that's not exactly the same day. Now, there are businesses where you work an hour, or let's say you work 8 hours in a day and they pay you on that day. That's rare these days, but it does happen still. So, but that's not really what we're doing here. We are working an hour and getting paid that hour in 2 weeks from now. So you're going to let's see, employee worked 1 hour at $30 per hour. Okay, something like that. Okay, now here's the trick. You're going to set up a liability. That's $30. And that's going to be salaries payable. Okay. And you have to expense it. And this is $30 as salaries expense. Following me? So on 1/1, when they did that 1 hour of work, you have your account here as a salaries expense, and your credit, and this is for 30, and this is going to be 30, but it's going to be salaries. Now there's all sorts of other entries that could happen associated with this, because like you have Social Security, you have taxes, you have all sorts of other things that happen with salaries. So this is just one little small snippet of what you would accrue. And the book goes through the whole gamut of all the things you have to do for salaries. One of the most complex things to do. But this is the initial entry, okay? And then when you actually go to pay them, let's say you pay them at the end of the month for that 30 hours, and then pay, let's see, let's just say run payroll. So when you run that payroll, and let's assume it's just that one employee for that month, then you're going to end up subtracting out cash, and you're going to subtract out, oops, the salaries payable. Okay. So with that, then journal entry looks like salaries payable and cash. And these are $30 each. Okay. That's one transaction. There'll be multitudes of transactions that make up not only the salaries payable, but the payroll itself. But this is how the journal entry will run in terms of accounts, and then debits and credits. Values you can just, change depending on what the specific scenario is. Okay. Now the reality is that they don't do it exactly like this. It's more like it's when you cross over periods. So this one may have been like 1/31. You have 1 day, let's say, of expenses that weren't salaries that weren't paid, so they'll accrue it on the 31st, and then when they go do the payroll, let's say on the 10th, then they pull it out. Right? It's usually do the accruals at a period of time when you're shifting from one accounting period to another. So at the end of the month, end of January, you look at all your payroll, what you haven't paid yet, you accrue it, and then when you go to pay it, you reverse that out. Systems are a little bit more dynamic than that if you're working, because they'll do it automatically. But if you're doing this by hand, you'll usually wait till the end of the month to figure that out. Okay, that's your revenues and expenses, deferred and accrued, and why and how and all that jazz. Any questions on that? Okay, hearing none. Let me see if there's something I missed in here that you might want to be aware of. This is the revenue side. You know, they walk you through kind of how that looks. Then you have your video here for that, and you have your journal entries, very similar to what I did, but just in a more formal format. On the expenses side, yep, they're walking you through, you know, asset versus expense. Prepaid insurance, they walk you through that one. Supplies. I don't like the word supplies. This is an asset. I don't know why this is my biggest gripe about some of the nomenclature they use here, but most companies don't accrue supplies. They accrue inventory. They book inventory, things that they're going to sell in the future. But some, it looks like they're making a push to accrue for supplies that you purchase and you throw into like a you know, a big supply room, right? So you maybe have a couple $1,000s worth of supplies in the supply room. You don't actually use it, so theoretically, then somebody has to come in on a regular basis, let's say every month or every quarter, and you have to do an inventory of all the staples and all the paper and all the what other supplies you have, and then they figure out, you know, what they recorded last month and what they have this month, and they make an adjustment. And you have other prepaid expenses. Okay, so they did cover depreciation on here. Depreciation is a form of accruals and deferrals all in one. Yeah, I wonder if they do depletion as well. They do accumulated depreciation. Let me walk through that. Okay. What kind of asset do you want to buy today, Josh?
Chocolate.
Chocolate?
Sure.
Okay.
I was gonna say a car, but chocolate's fine.
How about a chocolate maker? A cacao grinder. How about that? We're gonna buy a cacao grinder. Okay. Because we want to make chocolate, so we need a grinder. Let's say that grinder is $2,000. Okay, and let's say the life of the grinder, useful life is what usually called useful life, is, let's say it can go for 10 years. Okay. And we bought it, purchase date. I'm going to make this tricky on purpose. I'm not going to make it simple. Let's say we bought it on the 15th. Well, yeah. Sorry, 1/15/2023. Okay. All right.
I already see where you're going with this.
You're going. I'm trying to make it a little more complicated, so when you actually get to real life, you'll see what's going on, especially with some of the questions. Okay, so you bought it on the 15th. It's got a useful life of 10 years, and it's $2,000. Okay, now depreciation is the allocation of that $2,000 over 10 years. Okay, that's that's what depreciation is. So every month, I'm going to take an adjustment to two accounts. So the two accounts are usually involved here is, let's say, equipment and depreciation. Well, actually 3 accounts. Accumulated depreciation, okay? And then depreciation expense. Okay, those are the 3 accounts that typically, well, you got one more, sorry. You can't have 3. You always have to have kind of like 4. Of course, cash or some form. You could have lots of different ways of doing this. I'll take you through the most complicated version of this so you can see the ins and outs. Okay. So I'm going to run this by a journal entry. Okay. So we're going to start out with a date. We're going to account, a debit, and a credit. Okay. I'm going to take you through one of the most complicated versions of this. So first, on 1/15/2023, we purchased the equipment on credit, not with cash. Why would we make it simple? It's on credit because almost everything's on credit.
Because you want the reward points for the credit card.
Yes, that's right. You want the reward points. We won't factor that into this because that'll make it even more complicated. But so we're going to put in equipment. Okay. There might be a specialized account for certain types of equipment. We're just going to generalize it to equipment. And so that's $2,000, right? It's coming out of
Accounts payable.
very good, Todd. Oh, sorry.
No,
Okay.
it's 2,000, not 200. That's a
Yeah,
journal
2,000.
entry.
Okay, so it's not really coming out of, we're increasing accounts payable, right? We owe somebody $2,000. And let's say we paid for it. I won't worry about payment yet. Okay, so then we get down to 1/31/2023. We're going to record a depreciation entry. Okay, we're going to accrue, or we're going to adjust, however you want to call it, depreciation. Now, in this, because we're doing the evaluation, well, I'll first give you the accounts. That's the easy part. All right, so we're going to record it to a depreciation expense, and that's the debit. And the credit goes to accumulated depreciation. Now, I can't remember. Have you guys learned about contra accounts?
Yes.
Yes.
Okay. So accumulated depreciation is a contra account. It's an asset account, but its normal credit, its normal balance is a credit.
It's
not a debit.
opposite of the asset.
Yeah, it's opposite. That's why it's contra. It's contrary to your normal opinion of what an asset should be. It's negative. It's a credit balance, not a debit balance. So when we credit it, accumulated depreciation goes up. Okay. Now the question is, what do we record the value of? Now I'll do a little calculation up here. Monthly depreciation is going to be the $2,000 divided by 12. Divided by 10. That's the number of years.
Divided
Right.
by 12.
Divided by 12 gives me the number of months.
There you go.
Okay. Now, so theoretically, each month I'm going to record $16.67 in depreciation for this specific asset. But I've only got 15 days. Well, I'm gonna call it 15 days.
No,
Make it
you have
simple.
16 days based on the
Okay.
date that you put there.
All right, I'll do that. Okay, so what I want to do is I'll do this formulaically. I'm going to take the date minus how many days I started in the month. This is the only month you have to do this. Okay, so that's the number of days. This makes this a little easier. Okay, that's the number of days in the month. And I'm going to times it by,
Monthly
before I
depreciation.
do that, this is a little tricky, huh? Yeah, this is a little tricky. I'm going to times it by this number divided by 31 days in the month. Okay, so effectively $8.60.
So why did you do it 31 days in the month? Because in accounting, all months are based on a 30-day month.
Or 31 in this case, yeah. It depends on what you're looking at. Sometimes there are 30 days every month, but that's a financial number, not necessarily an accounting number. So there's different, so okay, let me just say this differently. Usually in financial speak, financial days are usually something like 360, 365, right?
Actually, I thought financial days were considered 360, therefore each month was considered a 30-day period that got you your 360. I thought that's how it was.
Yeah,
If
sometimes.
if I'm speaking out of turn, please let me know.
No, I get confused with this all the time too. So let's just go to the book, see if they've got it in here. The because some calculations are divided by 360 and some calculations are divided by 365. And so we have to remember, looks like they are running, that's 60 months. Are they splitting hairs on days on here? I don't think they're splitting hairs on days. Not on
I
this
think
one.
they're using that on based on a 360-day year, not a day for day year.
Yeah. Okay, I don't remember which one's which. My recollection was that financial days were 365, but we'll go with financial days are 360, but accounting days are actually how many days are in a month? It's usually 365 year
If it's
And
365, then everything is
varies.
literally day by day.
by day. Yeah. Because there's only 1 year there where there's less or less than or more than 365.
Leap years.
Yeah. Because otherwise, like in February, I mean, if you're just doing it by month, you don't have to worry about it. But when you have a partial month like this, you have to worry about it. You have to worry about the date of that month compared to the date that you're looking at. You
See,
can't just
I
use
came
30.
out with 8.87 because I was basing it on a 30-day basis, not a 31-day basis.
Yeah, but if this was 228, 23, right? And we had bought this in, let's say, 210, you'd have a different calculation. There's a number of days.
I see where you're going with this. Okay.
Right? And so this really ends up being, 28. Right? So it all depends on how many days are in the month as compared to the month that you buy it in, if it's a partial month. The easy thing is if it's, you bought it on the 1st of February, then you just take the full month depreciation. You won't have to worry about it. But if it's a partial month, then you do have to worry about it. Okay.
So it's
So
kind of like the difference in doing different ratios where some things you have to do an average based on a couple of years, where other things you're only looking at current year dollars.
mhm.
Okay.
Okay, so I'm just gonna back this up a little bit. All right, so I'm assuming bought it on the 15th. I'm doing the depreciation as of the 31st for that month. So I have $8.60. Okay, let's say I don't actually pay I have 60 days to pay off the equipment. So I'm not gonna do anything in February, but I will do another depreciation calculation. Okay. And on that, we're going to do this just a full month. We don't worry about anything here. We're just going to take this number right here and we'll call it good. Oops. Yeah. Okay. Sorry.
Aren't you there you go. I was going to say, aren't you missing a dollar amount for the December 31st one? There you go.
Yeah. So on the January 31st, it's a partial month. So I have to calculate the number of days times a fraction of the monthly depreciation to get that expense. And it goes to accumulate depreciation. On a full month, I can do this. And then let's say on 3 15, I actually pay it off, and so I'm gonna have accounts payable of $2,000 and cash of $2,000. That is sort of your life cycle of a purchase of equipment and a couple months worth of depreciation, all the way through to the last month of, well, it'd be 2033, right? So January of 2023, you'd effectively have $8.07 left over to record in that month, all the way back in January 2033, right? Because
So by what you just did in this example, you purchase equipment with a credit card, which was your January 15th equipment and accounts payable. And then the credit card got paid basically 60 days later in March. So the accounts payable is technically zeroed out because you're getting rid of your credit by creating the debit, where you're now expending the cash.
Yep.
But that doesn't still alleviate you from the depreciation expense and the accumulated depreciation accounts for the remaining time frame of the useful life of the equipment.
That's right. That's right.
That has to keep going month after month after month.
Until you dispose of it or until you fully depreciate it.
Okay.
And you'll get into disposal later on. But this is just how do you calculate? This is the basic approach to calculating depreciation, what you would do for a partial month, and then what you do for a full month.
So when you get rid of something, is it referred to as surveying?
No, disposal of an asset.
It's just disposal. Okay.
Yeah, disposal of an asset. You can also do a repair, a capitalized repair to an asset, which will extend its useful life and increase its total value and therefore depreciation, but that's for another time.
So a repair would be another adjustment to the equipment and possibly accounts payable or equipment and cash account.
Yes, and then
And it would just
temporarily,
it would just extend whatever the useful life is.
and probably the depreciation amount.
Okay. Yeah, because you'd have to add the repair to it.
Yeah, exactly. Yeah. Okay, Mary, any questions on the depreciation?
No, you clarified it very well. I was very excited for it because it's one of the things I
Okay.
was having issues with was trying to
It
figure
looked
all
like
that out.
Josh just dropped off.
Yeah.
Yeah.
Okay, so that's the depreciation side of things. And I try to give you not a full dose of all the variations of this, but at least the initial, starting point of how depreciation is calculated, what to do with partial months and what to do with full months, and then what the ins and outs are for when you actually buy it and pay it off, right? Just in case you get something other than cash as your deal. So I basically gone over these three. That's good. Okay. Well, for supply, expenses are pretty much the same, with the exception of salaries. The only caveat on salaries is that there's not just salaries, there's all the taxes associated with it. So I think in a future chapter, we'll go over that in more detail. Okay, revenues we did. Accruing, I already got that. Accrued revenue, trial balance. I give you kind of a quick view of this, but not necessarily in this format. Trial balances. I don't have much time. Are there any questions about trial balances?
So we kind of experienced this. I'm trying to remember. Did we get into this on exam 1?
Probably not. No, just a balance
No,
sheet.
okay. I think it was the quizzes after the exam is when we started kind of getting it a little bit into the adjusted trial balance when it was talking about, no, it was on exam one, and it wasn't about this. It was when you make a mistake in your journal entries, what is the impact on your assets, liabilities, and or equity? So I'm sorry, I was confusing them, but they're kind of the same based on the questions, because you have to understand where you made the mistake, what impact is it going to have?
Yeah. So like if I made a mistake here, right? If
$200 instead of 2,000.
exactly, if I made a $200 entry in accounts payable, what's the impact? Right? Well, what you really have to do is just look at the difference in the numbers. Well, for me, if it's 2,000, I put 200, the difference is 1,800. The question is that a good thing or a bad thing? Or probably said differently, did that understate liabilities or
There you
overstate
go. You just said the key word: understate, overstate, or no impact.
Exactly.
Yeah.
Right? So that's the trick here. And so if you know, you have to know what the normal balance is, the normal credit or debit balance is for the account.
So in this case, you would be understating the accounts payable.
Exactly. Yes. Because a normal the accounts payables normal balance is a credit. And so if I haven't credited it enough, I've understated it. Same with this other case, if this is $200, then I would have understated equipment.
Yep. Or overstated accounts payable.
Yeah, or overstated accounts payable. If it was truly just a $200 piece of equipment, right? Then I would have overstated accounts payable. So you just have to understand, one, what's the value differential between what you should have done and what you did. Okay, that's number one, just the value, the raw value. Then the next one is it over or understated? And that's all based on the normal balance for that account. Okay, would you have increased it or decreased it depending on what you should have done?
So where it would be like no impact would be something like you put something in an expense account versus a dividend account. So it really has no impact on equity because both of those accounts are normal debit balances. You just have either understated or overstated the expense or the dividend.
Yeah, that would be an odd example, but yes, that is a plausible example. It might be something more like in the case of where was this one I just showed here? Where the accounts are right here. Okay. Your journal entry is hitting the asset account area, right? But if I accidentally put in $1,000 on both sides of this, and it should have been 1,200. What am I doing here? 1,200. Let's say $1,000. There is an impact to assets directly. It's a $200 impact to assets. It's overstating assets effectively because I haven't reduced cash enough, right? But there is a possibility that if instead of making a $1,200 entry on both sides, there's no impact to the asset side of the equation, but there is an impact to the individual accounts themselves, right? Because in essence, these zero themselves out on the asset side anyway. So that might be a no impact type of a evaluation on the assets, but it would be an impact on prepaid insurance and or cash. Okay, so just real quick, your trial balance then just takes all these accounts and then records their values in their proper location, right? Either normal debit or normal credit balance. And you should balance all the time on this, unadjusted. Then you make your deferrals, your accruals for revenues and expenses. And then you should have an adjusted trial balance that balances out as well. Okay, so your adjustments should balance out, your final trial balance should balance out. And then usually what you have is these little notations here that indicate what you're doing. Okay, and this one doesn't show it in full detail, but it may say something like on this one, no, excuse me, let's find the front. F, what's F? You can't, oh, F looks like you're, okay, I know this one just by looking at it. You've accrued some revenue. Okay, F is an increase to revenue and an increase to accounts receivable. Or this one, 1,050, looks like you are adjusting your supplies account for what's actually been used and you're expensing it. Okay, so you can follow these references and then determine what might have been done. So like on this one, the $300, you recorded depreciation expense for equipment, right? Salaries expense, you might have recorded salaries payable for compensation earned but not paid. Insurance is, this one is you
right,
are
so
recording a
can
month's worth of insurance.
So Brian, on example number F,
Yeah.
it is the credit column a negative $1,800 because a negative plus a negative would actually be a positive, wouldn't it?
No, this one's this
Or
is
do
a
I just,
credit
do
of
I have a
1,800.
speck? Oh, I had a speck on my screen.
Yeah. Yeah, this is just a credit of 1,800, no problem. And a debit of 1,800 on accounts receivable. So they're accruing revenue on this one.
Okay,
Okay, so in essence, you should be able to do what I just did at some point in this course, hopefully earlier than later, right? You should be able to see these adjustments and say, okay, F is $1,800. It's a debit to accounts receivable. It's a credit to consulting revenue. Why would that have been? Right? And the answer is, should be eventually obvious to you, right? If I got an expense here of 210 and a payable of 210 on salaries, the account should tell you what's going on. The debit and credit should tell you what's going on because it's either an increase or a decrease, right, to those accounts. And so you should start to be able to provide determine or come up with an educated guess on what these are. And then your adjustments. All right, and then your financial statements, just take all these accounts and then put them in their proper place, right? Income statement, retained earnings, and balance sheet. And this walks you through where these accounts show up. So that's good. This is a good little graphic on where, and these accounts you see here are ones they use day in and day out in this course, right? So once you get familiar with what's an asset account, right? What's a liability account? What's a equity account, revenue, and expenses, you'll start to be able to place these in the right locations on any of the income statements or any of the financial statements, sorry. So this is a nice reference for that. And this is also a nice reference for what they look like or what should go in them. Okay. Very straightforward.
we've seen them a whole lot of times.
Yeah.
In all the smart books that we've been doing.
And you'll see them a lot more, right? So every little piece of this.
Well,
will be
it was
used
like
over and over.
on quiz on exam one, when towards the end of the exam, we had to do these, and the first one was like, for me, it was as long as you could get through the statement of retained earnings, because that was the first one, then it went to the income statement, then it went to the balance sheet.
Mhm.
As long as I could get through and remember what went into the statement of retained earnings,
Mhm.
the income statement was pretty straightforward because it is exactly what it is. And then everything else went into the balance sheet. The biggest thing was remembering, is it a point in time or is it a period of time?
Mm-hmm.
Month
Yeah.
ending December or December 31st?
Yeah. Yep. Okay, so those are your trial balance and financial statements. And then closing the, this is old school, but it is what it is. Taking all your expense accounts and doing them to the income summary, all your revenue accounts and booking them to the income summary, and taking the income summary and booking it to retained earnings and dividends into retained earnings, right? So this gives you a flow for how that closing process works fundamentally. But just remember, all your expense accounts and all your revenue accounts all flow into your retained earnings at some level. Net income, boom. Whatever it happens to be, net income was 3785, which is, this is effectively your net income summary, right? 3785 goes into retained earnings and it's reduced by whatever is paid out in dividends. Okay, so I won't belabor this one. Oh, this is a lot of a lot of account ledgers, effectively. And then your trial balance at the end. This is a good overview of the accounting cycle. Transact, journal, post, prepare, adjust, prepare adjusting trial, prepare financial statements, and then close your accounts.
And then repeat month after month after month.
Day after day. It's the same thing.
Never ending cycle.
Never ending cycle. Probably why I'm not in accounting anymore. It's good to start out in if you're really interested in accounting or that world. It's a great place to start because you learn how business functions. But there does come a point where, at least for some of us, you need a little bit more. So classifications, categories, yeah. Well, I think that's about all I can give right now. There's not much more in this. Profit margin is pretty straightforward. Net income divided by net sales. That's your margin and your ratio. Okay, so you have a couple of ratios and remember.
So current ratio, you don't do averages.
No,
This
current
is-
ratio is just what you see on the balance sheet, current assets
that-
divided by current liabilities.
And that's it. Yep.
Yep. What you see is what you get. All current. Current. I think these are usually the easier ratios that you have to remember. There's others that are more difficult, like the inventory turnover or the sales turnover. Those ones are a little bit more complicated because they do require a bit of remembering that it's averages and what averages you have to use and what's your denominator, what's your numerator. For me, these tend to be a little bit more straightforward because they are what they say they are. Profit margin as a percent of sales and current ratio, just assets over liabilities. And then you have your comprehensive, need to know. Okie doke.
All right. So next